Alrighty, time for our fiscal focus segment, as always brought to you by InfoChoice, your choice of information on Australian consumer finance. Now, by now, you've probably heard over the past week or so that changes to negative gearing and capital gains tax concessions are now widely expected after it emerged that the Treasurer asked his department to model the impacts of such changes. Now, the government is keeping tight-lipped about it at the moment, so we don't know what the potential changes are or indeed if they will happen. But it has certainly ramped up debate over this hot topic. But how could removing or curtailing these tax concessions impact the underlying finances of property investors and property owners? Well, joining us to share some insights is the acting CEO of LocalAgentFinder, Suresh Raghavan. G'day, Suresh. Welcome to the Savings Tip Chat podcast.
Thanks for having me, guys.
Thanks, Suresh, for joining us and sharing your thoughts of this afternoon. Just straight off the bat, what is negative gearing? It's a pretty hot buzzword at the moment, but can you explain what exactly it is so our listeners know exactly what to expect if this comes up?
Yeah, absolutely. It is a bit of a hot topic at the moment, obviously, negative gearing, being essentially just the ability to claim a loss with any investment that you make against your personal income. I don't think it's any surprise to anyone that if you're a business owner, for example, if you own a small restaurant, things like napkins and spoons and cutlery and things like that you buy, you deduct that from your income that you make, and you get taxed on the profit that you make as a business. For negative gearing, that's pretty similar. If you're a property owner, if you have a day job and you make $100,000, but you have a rental property and that makes a loss after the interest that you pay on the loan on that, after depreciation and things like that, you can deduct that from the income that you make, and that forms a tax deduction for you. So there's a benefit there for investors where you can lower your taxable income.
So, Suresh, we're talking there about impacts on investors of removing of the potential, plans to remove those concessions or even just reduce them slightly. But how about for owner occupiers? Could there be any impacts on them too, directly or indirectly?
Directly, maybe not. I mean, they're not claiming deductions as such as owner occupiers, and you can't negative gear your owner occupied property. But certainly negative gearing could have impacts on how money is allocated, where investors want to place money. One of the big benefits of negative gearing is that, yes, you do take a loss. You benefit a little bit from the deduction that you make. But over the line, what many investors are hoping for is a capital gain from that property. If not as much money is flowing into property because there's not as much benefit from the tax deductions, there can be impacts on housing supply, there can be impacts on prices, there can be impacts on rental supply and prices as well. And all of those could indirectly impact an owner occupier as well.
Yeah, Suresh, it really came to a head, I think, and people started taking notice of the whole term negative gearing in 2019 when Bill Shorten came to the election and said that he would abolish negative gearing for property investors, and that kind of spun off into a whole other world of property investors being a controversial topic, negative gearing, CGT concessions, and so on and so forth. But can you explain exactly why it is controversial?
I guess why maybe it's receiving a lot of strong opinion right now. Negative gearing does benefit a property investor. I mean, if you've got an investment property that is making a loss, if you weren't able to make a deduction, then you are making a bigger loss than in the case where you can deduct it against your income. So obviously there are some people that are out there investing, they're looking for capital gains potentially off a property, where they may not be investing if they weren't getting that tax deduction or that little bit of tax relief from the investment that they're making. So there are a lot of people in Australia that are in that situation. I've seen some figures around there quoting something like 1.3 million rental properties are currently in loss. So significant number of these properties that are out there, and I think that's what potentially makes it controversial. It's a pretty big part of the investment landscape, and investors, when we talk about investors, it's not necessarily this little niche group of people. It's everyone, right? A lot of people that you see at the barbecue, your friends and family, will be investors, and because it touches such a large swathe of the population, I think that's what has created some of this controversy and some of the strong opinions.
Now, the property market, Suresh, was already so uncertain to begin with, and then you throw in these potential changes to negative gearing into the mix, and it just becomes a whole less uncertain. I mean, so with that in mind, how important is it for the government to really provide some clarity to the market so we can move forward? And also, how can property owners navigate this uncertainty?
Yeah, it's a really good question, Dom. I think from that perspective of certainty, investors always want certainty. And I mean, one of the hot topics around the debate is around housing supply and how negative gearing may or may not influence housing supply. Obviously, like things like this are aimed to benefit when investments are being made, and investors want that certainty, right? They want to know that if they're putting their money somewhere, that they're going to get the kind of outcome that they're hoping for. As soon as uncertainty comes into that picture, it's really hard to make those decisions. It's really hard to make those calls and decide, I want to put money here, I'm going to invest in this property, and that uncertainty in itself can have a lot of impacts on how our markets function, whether it's a stock market or the property market or any of our financial markets. What we definitely see here at Local Agent Finder is, as an investor, if you own a property or even as an owner occupier, you always want to be prepared. You always want to be empowered with the right information. You want to know what your property is doing, what the value is, where you could go to market it. And there's a lot of things that people will naturally do, right? People will stay in touch with their mortgage broker. They'll try to refinance. They'll look at the best rates that are out there. They might have a financial advisor, and they'll try to get a better idea of depreciation schedules and how to structure their investments. But definitely where we believe we can help is really staying in touch with the market. You come onto Local Agent Finder, you connect with agents that match your characteristics in your area, and you're benefiting from people that are out there every day, these agents who really understand the market really well in your suburb or the suburb of your investment property, and can really guide you on that journey. Because if you do want to act, and when you are prepared to make that decision, you want to be empowered with the right information so that you can act decisively and act quickly as well.
For sure. It definitely sounds like over the last few years, there's been a bit of a squeeze on property investors. And I'm sure there's a lot to navigate with agents on your panel, what queries they're fielding. But just off the top, like why is there just this like all this hullabaloo about negative gearing? Because to me, you can do it with shares. Like if you make a loss, you can write that off against your tax, which sounds pretty reasonable. But for property investors, it's pretty controversial. Why would you do it? Because it doesn't seem like a pretty sound long-term strategy. Because at the end of the day, you're still losing money, but that policy allows you to just lose less of it.
Yeah, really good question. I think it is a combination of our entire tax policy, and I'm not a tax person, so I'm gonna talk about this from a bit of a layperson's approach. But obviously, we've got the capital gain discount if you hold an asset for more than 12 months. And when you think about like an investment property, and especially what's happened in Australia over the last several years and even decades, property prices have been going up. So if you were in the property market and you had an investment 10 years ago in a certain suburb, yes, you're probably taking losses on for the first couple of years, but at some point in your ownership journey, it flips because rental yields start to catch up, property prices go up, so you're making more off the rent. But also at the point that you decide to sell, you're getting a 50% discount on the capital gain, which is really beneficial. So even though you're taking those losses, the end picture of that entire investment can be quite positive for a lot of the people that entered into these investments.
It does sound like with so much potential, risk of government changes around things like negative gearing, that people shouldn't depend on it too much and really need to probably stick to the fundamentals when it comes to investing in property. Suresh Raghavan, really appreciate your time on the Savings Tip Jar podcast. Thanks so much for your insights.
Thanks, Harrison. Thanks, Tom. Appreciate you having me.